How do the numbers work when you're selling your property portfolio? Hi, I'm Kimberly Shapcotts, qualified chartered accountant, property investor and entrepreneur. Let's sit down and have a chat. Selling your property portfolio is a big decision in your life, and it's probably one where you've possibly held those properties for a number of years. So the potential capital gains, the potential tax implications are going to be relatively large. So let's do a worked example today to give you an idea of how it all fits together, because it's probably going to be quite important for you to understand how and what options you have available to you should you decide to sell things in one go, or if you decide that actually to sell things on an individual basis. So let's dive into an example of selling a whole portfolio today so you can see what the tax implications are and whether this will be the right route for you to be taking. Let's dive into the numbers. Let's dive into our example. Today we're going to look at an example with someone with a 5-property portfolio. And in this case, they have got 5 different properties, as you can see, with different valuations, which get us up to a mark of £1,010,000. They purchased the properties for £755,000, and we've got details of each of the different properties that were purchased, and different ones had different improvements over their life. So we've got £135,000 of improvements. Over the time period that they've been purchased, you have got the stamp duty valuations, and we paid some legal fees for that as well. In addition to this, we still have mortgages on all of the properties. So we need to take this into consideration as we are doing our different things. We've got our disposal costs for how much it's going to cost to sell it. This is quite limited. There may be more costs for estate agencies depending on what is being paid for these. So these costs may vary on your portfolio, but this is just to give us something to incorporate into our calculations today. Based on all of these, we've calculated what our gains are. So this is the current value, take away the purchase price, the improvements, the stamp duty, the legals when we purchased it, and the legals when we've come to sell the property. Now this is giving us our indicative gain that we've got on screen here. So overall on this portfolio, we've got about 85,000. Which means we've got a nice 86,000 of gain that there will be some sort of tax payable on when we come to sell the properties. Now, when we actually look at the cash after the sale column, this just gives us an idea of what is actually going to be received when all the properties are sold. And the reason this is obviously higher than the gain is because we've got a mortgage on part of the properties, and there is some equity in those properties that when we sell them, we will get out that money. The one thing to note on this summary is we've not got any capital gains tax implications showing on this yet. So although we're saying we potentially could be getting 325,000 out of this portfolio, the figure is probably going to be somewhat less on the basis we are going to have some capital gains tax to be paying. Obviously everything we've got here is all for illustrative purposes, but hopefully this will help us explore what we have in terms of options and the impact from a capital gains tax point of view depending how we sell this portfolio. There are several different options we have available, which include selling the whole portfolio as a whole or selling each property individually, which we may want to swap over different tax years to take advantage of our personal tax allowances for capital gains tax, which on the release of this video are sitting at £3,000. Other options that we should be considering is if something is owned in individual names, whether it may be worth transferring it into joint names with a spouse to give us an additional £3,000. You may need to just balance up what the legal costs are of doing this compared to getting the tax saving of the additional £3,000. So let's dive in first to see what it would look like if we were to sell the portfolio as a whole, which in effect means that we are going to be selling everything all in one go in one tax year. So this means we're hopefully going to be maximising at our just over £1 million value for the portfolio, and we'll be reducing this by our purchase price, our improvements, stamp duty, legal fees and our disposal costs to get us down to that 85,955k. We then can take off our personal allowance, which actually gives us a taxable gain of just under 83,000, and this is what we're going to be taxed on. Now, the worst case scenario is that all of it is going to be taxed at 24%. So this gives us our figure of 19,909 and 20 pence, so just under 20,000 that we're going to be losing in tax costs. Now, I do appreciate some of you out there may be saying, but I'm not a high rate taxpayer yet. So there may be an element that you can pay some of it at 18%. So if you were to pay all of it at 18%, that would bring you in at just under 15,000. Now, many people out there may go, well, actually, on this scenario, I'd probably pay a bit at 18% and a bit at 24%. So we've probably got a bit of a hybrid that would be happening. But hopefully you can see worst case scenario for selling everything all in one go, assuming you've got income potentially over the 50,000, you're going to be at about 20,000 tax that you need to pay. As this is a capital gains tax on residential property, that will need reporting within 60 days of that disposal, and the tax will also need to be paid within that disposal period. So you've got 60 days to get all of that sorted, all of the returns submitted and the payments made. Now, probably the key question, which is probably what we're more interested in other than the capital gains tax amount that we need to pay, is going to all be to do with, well, what money am I going to get out of this? So based on where we were before, we can see here we've got our portfolio value of just over £1 million. We've got our mortgages, which are in at 678,750, which means after our disposal costs, which we'll be paying out, and after that capital gains tax, which we've just incorporated our worst case scenario here, everything being at 24%, we're down at 305,340 and 80 pence based on our calculations today. So from our £1 million of property that we are selling, we're going to end up with just over 300,000 in our pockets to walk away with for our investment, which hopefully is a good return depending on what you have done with the investments. So that gives us an idea of what sort of tax we'll be paying if we need to do things on a one-off disposal of everything. But there is the option and the benefit that you may go, well, I don't necessarily want to sell it all. Maybe the capital gains tax would be cheaper if I did it in a slightly different way. So let's have a look at it based on the fact of selling things individually. And I've just got the summary up here again as well, so we can see all of our key figures that we had before. You will notice that our figures hopefully look similar, but are slightly different in our cash after sale, because I've put in here what we have actually got after we've disposed of each individually. And we'll come back to this after we've been through each of the different capital gains tax calculations. So the key question here then becomes, what order should we be selling the properties in? And for our example today, I've chosen a very specific reason for a very specific point of why I've chosen what I've chosen. And the main reason is because we don't know what is happening with capital gains tax. So I have worked on the basis that things may be getting worse and there may be future changes and increases in rates, which means in essence what I want to be doing is want to be selling things in the biggest capital gain first, so I know what the tax position is. Because if things are going to get worse, I want the worst to be on the lower figures, not on the higher figures. So on that basis, property 4 here is the one that has got the biggest gain. So I've put this in as the first one that I want to be selling, and then I've worked backwards in terms of which ones are the biggest gains. Now, when deciding on an order to sell properties, there may be several different reasons. I've chosen based on the gain that has been made. You may look and go, I actually want to get rid of things in a specific area because I don't want to be traveling to that area anymore. So that might be, it's more a location based, and you get rid of the ones furthest away from you first, keep the ones closest because you can manage those easier, and then you dispose of those properties. It may be there are specific ones that are easier to sell than others, and actually the market in that area is getting you a better price at the minute than another area, and you want to give the other area time to get back up to a better rate. So there's many reasons why you may want to choose the order you choose, and in some ways it's just looking at it logically to see what is going to be the right move for you based on what is happening with your portfolio. Now, based on that, let's jump into the calculation for property number 1 and see how that fits together. Now, as we saw a moment ago, the process of the capital gains calculation is relatively similar, except this time we're just taking the property 1 sale and we're taking the purchase price and sales price of that. So we've got for property 4, it was 250,000 that we are selling it for. We bought it for 125,000. We've got some improvements of 75, some stamp duty, some legal fees, some disposals. So we're down at 43,800. Because this is a separate tax year, we can take off our 3,000, which gives us a capital taxable gain of 40,800. And again, we've done worst case scenario at all of it being at 24%. So that's at 10,000 compared to if it was all at 18%, which is just over 7,000. So based on a worst case scenario, the amount of money we would get out of this property would come in at around the 70,000 sort of mark. So that's hopefully a healthy gain in terms of money in, and depending what you're doing with the rest of your portfolio, it may be you start reducing mortgages down if you need to refinance and use that money to put back into a mortgage so that the rental income on the other properties while you still have them are higher than they were before. It may be you use that money to fund life, and depending how much you need to fund life, whether it be 20k, 30k, 40k, that might last 2-3 years to give you some sort of income stream to pay for what is going on in the rest of your life. Or it could just be a great grand cruise around the whole of the world, whatever floats your boat. Now this leads us on to then property 2 that we're going to be selling, which is actually my property 1, but sale number 2. And this would then be done in a different tax year, which we're talking from the 6th of April each year to the 5th of April each year, and we just need to time it so it's in separate tax years to enable us in essence to be getting that personal allowance of 3,000 again. If you transfer it into joint hands, then you'll double that to 6,000, and then it will be based on their tax position, and they may have some 18% tax as well as 24% tax. So there is a bit of a balancing act here. Now, I have worked on all my calculations here on worst case scenario, so everything's going to be at 24% because you've got other income that is going to be taking you up to the 50,000. But potentially if you're disposing of a property each year, it may be that your income is decreasing. So actually that is also helping in the capital gains tax position because it's reducing the capital gains tax you're going to be paying at 24%, and you'll pay a little more at 18%. So there is a few other benefits depending on your personal position and what your income position is, as well as the disposals position. So as you'll see for our second disposal, we've got our 220k, take off our purchase price of 175, improvements of 20, stamp duty of our 5250, legals in at 750, and disposal cost of 1200. So here we're getting a gain of 17,800. So we can take off our personal allowance, which is giving us a taxable gain of 14,800. And here our tax at 24% is coming around 3.5, or at 18% is down at 2,600. So as you can see, with the gains being that little bit lower, it may be that they are actually coming in at a lower 18% rather than the 24%. Worst case scenario though, on this, the money that we would be getting after the disposal of this would be coming in around 65,000. So as you can see again, that might be paying for a year or two of life. It may be paying for a bumper holiday with the whole family. it may be you reinvest it again into the mortgages to bring down the mortgages if you are needing to do refinances, which is obviously maximising your income for the last few years while you've got the properties. Now, our third disposal is our property at 180. So again, it works, as you will see, in the same way, and we're just working through in a new tax year all of the different costs: our property sales price, purchase price, improvements, stamp duty, legals, disposal costs, to get us down to a gain of 13,000, which again, we get our personal allowance in that year, which is 3,000, to give us a gain of 10,000. And with our reduced rental income, it may be all of this is now getting taxed at the 18% rather than the 24%. So we've got our 1,800 at 18%, or our 2,400, should I say, at 24%. So as you can see, there's a few variations you need to consider for yourself, but worst case scenario here, we're probably going to be getting 64,000 out of this property, which again, as we've said, could fund life, could fund holidays, could fund fun, could fund clearing mortgages on the final properties to maximise the income that you're still receiving. So this kind of continues down the process, and we get to property 4 here, which will be in another tax year, which it sounds like it's going to take 4 or 5 years to do this process, but depending on timings of when you do things, it may be you dispose of one at the end of March and one in April one year. So actually you could be disposing of things quite quickly, and it may be 4 tax years, 4 or 5 tax years, but actually with the timings of when you do them, it might only actually be 3 or 4 years, as you're selling things in quite quick succession, as long as they are in separate tax years. So sale 4 will be our property number 5, and we've got our proceeds of 160,000, take off again our purchase price, improvements, stamp duty, legals, disposal costs, which is getting us down to a gain of 8,700, which after our personal allowance is only giving us a gain of 5,700. So our tax here at 18% is coming out at about £1,000, and our tax at 24% is only coming in at 1,400. So this one again, as your income is reducing, you might actually now be at the 18% tax, which is not too bad in the grand scheme of things. So here, from a point of view of what are you going to get out of it, well, actually this one, the mortgage is a bit lower, so actually you're potentially getting around 60k out of this property, which is 60k, which will give you some money to keep going for life, investing, whatever you see fit now that you are disposing of your portfolio. And the final property is one potentially that was bought more recently, or there's just not much of an uplift on it, because here we've got our final property that we're disposing of 200,000 less the 175, 15, 5,250 and 995 and our 1,200, which is only giving us a gain of 2,500. Now, because our personal allowance is 3,000, that means that we're not actually going to have any tax to pay on this. So the money after our disposal is basically going to be a little bit of gain and our deposit out the property of just under 50,000. So if we go back to our summary, this means out of all of the properties as we dispose of them, we're going to be getting around 308,000, which compared to what we were getting out of the portfolio for doing it all in one go, at the minute is only showing about a £3,000 difference. So this is 308,000 or 305,000. However, we've worked on this on the basis of worst case scenario, so it's not very different, and we've included everything in our 24% tax rate. However, it may be if property 3 and 4, and maybe even property sale 2, all went through at 18%, there would definitely be some tax savings that would be going on here, because our tax would actually have reduced by further 2,000. So that would probably be taking us up to more like 310,000, 300 compared to 305,000. So potentially there is a little more saving by doing it the long way. And also, obviously, during that time, you would be getting rental income on those properties that you had retained. So you'd still be getting the income and you'd be saving some of the capital gains tax. So it's very much a swings and roundabouts sort of approach. It depends how you are managing your portfolio. It depends what is going to work for you. Every scenario is going to be slightly different, and you're going to need to do some numbers. If you're not sure, then I would suggest getting professional assistance, and they can do a predictive capital gains tax scenario for you to see what the capital gains tax is going to be, so you have a rough idea, and then you can have a look at what order you may want to be doing things and how it is fitting together. So there's definitely a few options, a few things you may need to be looking at, but hopefully that gives you an idea of how things will fit together so you can do some numbers on your portfolio, especially if you are looking at selling your portfolio in the near future. As you can see, there will be different variations depending what you have done with your portfolio over the lifetime of owning that property portfolio. This will impact any capital gains tax considerations, and you may want to do some calculations before you make the decision of how you want to sell your portfolio to ensure that you're getting the right results that you're wanting. As you're doing this planning, I would suggest speaking to a professional, as they'll be able to guide you through this process, especially if there are any changes to capital gains tax legislation or any changes in the world of tax, to ensure that you are making the most of what we have available to us at the time that you're making this decision and at the time that you're actually going to be making the sale of this portfolio. Good luck with the sale of your property portfolio, and hopefully you can minimise the tax as far as possible. Hopefully today you've discovered how it fits together if you're looking at selling your property portfolio. If you have any questions, then please do leave a comment. Please like the video and do subscribe to the channel. And let's make tax less taxing. Let's make tax less taxing.